Joshua, that's a good question. The big difference between a first lien HELOC and a traditional HELOC is your traditional HELOC is going to be in second position, so you're going to have two mortgages on your house. A second mortgage with the HELOC typically gives you 3 to 5 years of what the bank calls a draw period. That's the time that they allow you to access the line of credit. The payments during that time is interest only. So once your draw period expires, your loan's going to turn into a fully amortized loan where now you got to start making principal and interest payments. And most people never pay off the debt within that 3 to 5 year draw period. Now, in a first lien HELOC, you only have one mortgage and you have access to that line of credit for 30 years. So it's a huge difference. And when you really look at your first mortgage, like I've talked about in other videos, you're paying interest first. Go look at your closing documents. The bank gives you your amortization schedule. Look how much interest you pay back the bank. Then go look at your mortgage statement. How much of your payment every month goes towards interest and how much goes towards principal. With the first lien HELOC, we're paying principal every single time a dollar touches the HELOC. That's how we can accomplish these fast payoffs and really get yourself out of debt. So if you can get into a first lien HELOC, that's the only way to go in my opinion. With a second mortgage, with a traditional HELOC, I think you're just kicking the can down the road and you're gonna be forced to either find another HELOC to replace your existing, or you're gonna have to find, you're gonna have to refinance into a first and second, combine your first and second into a first mortgage again. So once you're in the first lien HELOC, that's set it and forget it. You don't gotta touch that thing ever again as long as you're using it right.